Hello and welcome back. Today I want to kick off a three-part session on currency exchange rates. And in today's video, we're going to look at the interpretation of exchange rates. This is going to cover the notation used, the effect that inflation has on exchange rates. Then we're going to talk about spot and forward rates. The exchange rate is the number of units of price currency that one unit of base currency will buy. The price currency is in the numerator and the base currency is in the denominator. So when we have a dollar per euro exchange rate, that represents the number of dollars required to buy 1 euro. Now the convention is to express this from the perspective of domestic over foreign. So in this example, the dollar per euro exchange rate is from the perspective of a US consumer looking to buy euros. Now, a decrease in this exchange rate would mean that the euro costs less or that fewer US dollars are needed to buy 1 euro. In other words, a decline in the dollar per euro exchange rate indicates that the US dollar is appreciating against the euro or the euro is depreciating against the US dollar. Similarly, an increase in the exchange rate would mean that the euro costs more or that more dollars are needed to buy 1 euro. This would indicate that the dollar is depreciating against the euro, or equivalently, the euro is appreciating against the dollar. The exchange rates described in this fashion are referred to as nominal exchange rates. This is to distinguish them from real exchange rates used to assess changes in the relative purchasing power of one currency compared with another. We'll get into real exchange rates a little bit later in this video. Now we can calculate the percentage change of one currency in terms of the other simply by the application of this formula. That is, we take the new exchange rate divided by the old exchange rate and subtract 1. Remember that we always use domestic over foreign as our convention, and this calculation represents the percentage change of the foreign currency. Now if this is positive, that means the foreign currency has appreciated. We also refer to this as the foreign currency trading at a forward premium. Similarly, if new over old minus 1 is negative, then it implies that the foreign currency has depreciated. We say that the foreign currency is at a forward discount. Now it's important to note that we cannot say anything about the domestic currency using this calculation. This formula is always talking about the denominator currency, that is the foreign currency. So we cannot say that the domestic has appreciated or depreciated by this calculated amount. In order to figure out whether the domestic is at a forward premium or discount and of how much, we need to invert the exchange rates and then apply this formula again. For the same quote of domestic over foreign, the percentage appreciation will not equal the percentage depreciation. So the key point here is to remember that we can correctly calculate the percentage change of base currency in a foreign exchange quotation. Now let's get back into what we mentioned earlier in terms of the effect of inflation on exchange rates. Now in a world of homogeneous goods and services with no market frictions or trade barriers, the relative purchasing power across countries would tend to equalize. This basic concept is known as purchasing power parity or PPP, and it describes the long-term equilibrium of nominal exchange rates. So PPP asserts that nominal exchange rates adjust so that identical goods and services will have the same price in different markets. Now in practice, the conditions required for this to happen are not satisfied because goods and services are not identical. Many goods and services are not traded internationally, and there are trade barriers and transaction costs which represent friction in the free flow of goods and services. So as a result of these factors, the nominal exchange rates deviate from PPP. Now if you consider the case of a US-based consumer, increase in European inflation makes European goods and services more expensive to that individual. This is the same effect as the nominal dollar-euro spot exchange rate increasing. Now this effect of European inflation is offset for that American consumer by an increase in domestic income which has the same effect as the nominal dollar-euro spot exchange rate decreasing. So the real exchange rate takes the relative inflation of domestic and foreign into account. In this example, the real exchange rate would tell us the dollar cost of purchasing that same unit of goods and services based on the new dollar-euro exchange rate and the relative changes in the price levels of both countries. So the formula is that the real exchange rate equals the nominal exchange rate multiplied by the price level of foreign over the price level of domestic. Now let's turn to spot and forward rates. A spot rate is the currency exchange rate for immediate delivery. This, for most currencies, implies a time period of 2 days after a trade. A forward exchange rate, as the name suggests, is for settlement sometime in the future. So it's the number of units of domestic that will be exchanged for 1 unit of foreign at the date specified in the forward agreement. Forward exchange rates are typically quoted in terms of points, also known as pips. So points on a forward quote simply refer to the difference from the stated spot exchange rate quote, with the points scaled so that they can be related to the last decimal in the spot rate. Again, when the forward rate is higher than the spot rate, the points are positive and the base currency is said to be trading at a forward premium. Similarly, if the forward rate is less than the spot rate, the points are negative and the base currency is said to be trading at a forward discount. Of course, if the base currency is trading at a forward premium, then the price currency is trading at a discount and vice versa. Forward rates or points are also sometimes represented as a percentage of the spot rate rather than an absolute number of points. In this case, spot multiplied by 1 plus the percentage equals the forward rate. Finally, let's look at interest rate parity. Simply stated, when currencies are freely traded, the percentage difference between the forward and spot exchange rates is approximately equal to the difference between the two countries' interest rates. This is an approximate relationship, the exact version of which is forward over spot equals 1 plus domestic interest rate divided by 1 plus foreign interest rate. This relationship is known as the interest rate parity, and it holds because there is an arbitrage trade with a riskless profit to be made if this relationship were to not hold. So given this formula, it's clear that the forward rate will be higher than the spot rate if the domestic rate is higher than the foreign interest rate. Again, the forward and spot rates are quoted as domestic over foreign. More generally speaking, the currency with the higher interest rate will always trade at a discount in the forward market. That is, currency with the lower interest rate will always trade at a forward premium. Now, how we interpret this is that if the actual forward rate quoted in the market is lower than that calculated using the IRP formula, then it means that the higher interest rate currency has not depreciated enough and that the higher interest rate country should be invested in. That is, you would borrow in the lower interest rate currency and invest it in the higher interest rate so that future conversion at the available forward rate will yield profits. I plan to put up a lot of examples over the next few days that deal with the various principles that we've discussed today. And I think the best way to prepare is to do those examples and come back to this mind map to make sure you can apply these principles and really understand the intricacies of the concepts. Thank you. Hope you found that useful. I'll be back soon with more videos.